Hi, it's Brian Decker with your Market Minute. Want to cover this week's market take as an economist. An economist uses the phrase on the one hand and then on the other hand. So we've got different takes on the market that I want to cover. On the one hand, I want to tell you that since 1950, the S&P has been 10% higher through the first 6 months of the year, 23 times. The average gain for the US benchmark over the next 6 months, when you include all 12, is 12%. And it's been higher in 77% of those 23 instances. So history says that we're on track for a good year. On the other hand, we talk about how stretched the valuations are in the market currently. The S&P 500 right now has a long-term price earnings ratio that peaks out in 1999 and in November of 2021 at about 38 times earnings. And right now we are at 34 times earnings. So valuations are in the high end. On the other hand, we could see a melt up if the Fed navigates the economy's soft landing, because lower interest rates are going to help corporate earnings. On the other hand, if they don't navigate a soft landing with the economy, then we will have a recession. And a recession hurts corporate earnings, and the average stock price drops about 30%. There's something called the SAHM, S-A-H-M, the SAHM indicator, that indicates that when you have a 1% change or a rise in unemployment rate, that triggers inside of a year, that triggers a recession. We had a 3.5% unemployment rate a year ago. Now it's 4.1. So that trigger is on the verge of triggering. What about inflation? The Fed would rather not worry about inflation targets right now, because right now the trailing 12, the PCE, the Personal Consumption Expenditure Index, is at 2.6. That's close enough. The Fed's target is 2.0, but Powell said in the last interview that in the twos, the low twos, so anything 2.5 or under. So right now the market is expecting 2 interest rate cuts, September and probably August and October, for Fed rate cuts. So we'll see if that happens. The last thing, the current market valuation using the macro quant model, which is something we'll pull up for you, shows how overvalued the market is right now. It uses the present value of S&P earnings. The highest it's been is 80%. We're at 53 now. And we are the second highest we've ever been as a stock market. So we shall see how this plays out. It's Brian Decker. Hope you have a good week.